Hello, everyone, and welcome to today's webinar. We're so excited to have you here. I'm Hilda, Content Manager here at the DEO, and I'm joined by our speaker, Brannon Moncrief, CEO and Principal of McLerran Associates. And today we're diving into how to determine if 2025 is the right time to monetize your business or keep growing. Whether you're actively considering a sale or just want to be informed, you are in the right spot. So grab your coffee and a notebook and let's get started. So Brandon, I'll turn it over to you to kick things off.
Awesome, Hilda. Thank you so much. All right, here we go. Thanks for joining us. I'm going to start off just with a little intro. We'll get into today's agenda and then start getting into the meat of the presentation. My name is Brannon Moncrief. I'm Principal and CEO of McLerran Associates. To give you a little background about myself, I've probably met and seen many of you at the DEO meetings over the past couple of years, but I've spent my entire adult life, my entire professional career in the business of dentistry. So I spent about 8 years as a banker lending money to dentists all across the country to acquire, start, and expand practices. And then I purchased McLerran Associates 13 years ago. At the time I purchased the firm, it was kind of a small mom and pop brokerage firm like many of the dental brokers you see out there today, and scaled that business over the course of about 7 years, doing more traditional practice sales from a doctor-to-doctor perspective. And then about 6 years ago, we're based in Austin, Texas. We were on the forefront of a lot of the consolidation that started to occur by private equity-backed DSOs. And that's when we decided to build out a team, build out a process to represent large premier practice owners who are looking to affiliate with a DSO or bring on a private equity partner. So fast forward to today, and we closed over 200 DSO and private equity transactions nationwide. We work with general dentists as well as all dental specialties. We have 3 offices, HQ in Austin, Texas, where I live. We have an office in San Diego and an office in Atlanta, a team of 15 people that serves our clients on a daily basis. And I look at our job as being to educate and empower dental practice owners, group practice owners, to understand their EBITDA, understand the value of their business, and then ensure that they're making the appropriate decisions as they scale that business and eventually look to monetize it. At the time you look to sell your business, ensure that we create a competitive environment and you understand your options. We maximize the valuation, the deal terms, and you find the partner that's the right fit for your business on a go-forward basis. So today we're going to talk about current market conditions and the 2025 outlook. We're going to talk about how investors are evaluating DSOs at recap events, because I think it's critically important that if you are eventually going to monetize your business by affiliating with a DSO or selling to private equity, you need to understand how are institutional investors evaluating larger DSOs when they reach a recap and look to monetize their much larger business, because it has a significant impact on how they view the value and marketability of your business when they go to acquire it. We're going to talk about scaling your practice with intention and how to position your practice as a Class A asset when you go to monetize it. We're going to talk about aligning incentives with doctor partners and associates. That's becoming more and more of a popular topic that doctors are reaching out to talk to us about, and keys to maximizing your outcome at an exit. All right, so let's talk about current market conditions and the outlook on a go-forward basis. Over the past couple of years, we have been in a challenging macroeconomic environment. We've been operating with elevated interest rates. The capital markets have been very tight. Money got expensive and hard to access very quickly. And as a result, you saw less M&A activity in back half of 23 and all of 24 than you saw pre-COVID, and especially in the couple of years coming out of COVID. The good news is that the macroeconomic environment has changed in a favorable way to some degree. We're now in a decreasing interest rate environment. I think we were expecting to see multiple rate decreases in 2025. I would probably pull back that expectation a little bit. I think we may see 1 or 2 interest rate decreases over the rest of the year. But the good news is we're no longer in an increasing interest rate environment. So that's favorable. We had a favorable election outcome as far as how private equity looks at the economy and views government. Going into the election, most of the private equity firms and DSOs were rooting for Trump to get elected as opposed to the alternative. They feel that long term that will be better for the economy, less regulation, lower interest rates, and that will lead them to bring more optimism to our space. So, because of the fact that we're in a declining interest rate environment, because of the fact that PE likes the new administration, we've seen renewed interest in the dental space. In fact, there's been multiple recapitalization events that have occurred since the start of 2025, the most notable being MB2, one of the largest private equity backed DSOs in the country, recap just a few weeks ago. And we've seen some smaller regional DSOs go through recaps. There are multiple DSOs that are currently on market that have accepted offers that are expected to announce recaps here in the next few months. We have those seen increased scrutiny of DSOs by institutional investors at recap. So the reality is that a lot of private equity backed companies have delayed recaps until 25 and 26. They did not want to recapitalize their business when the macroeconomic environment was not favorable. So as a result of many PE backed companies delaying their recaps until this 24-month window, not just in the dental space, you're going to see a lot of PE backed companies go to market over the next 12 to 24 months. As a result, private equity can be choosy about those companies that they invest in. So they are scrutinizing DSOs more and more when they go to market and look to recap the business. And we'll talk in detail about that here in just a minute. As a result of DSOs facing more scrutiny from institutional investors when they go to recap, DSOs are being more prudent in how they evaluate acquisition opportunities. So we'll talk in a few minutes about how to position your business as a Class A asset and make sure that it's marketable and valuable to DSOs when you decide to monetize your practice. We are seeing strong demand for quality assets, and we'll talk about quality assets, what that means here in a minute. But I will make the note that valuations and deal structures have evolved over the past couple of years to deal with the unfavorable macroeconomic environment. Today, valuations and deal structures look a little bit more like they did pre-COVID as opposed to post-COVID. The market was super frothy in 21 and 22. Valuations were at an all-time high, and deal structures were very clean, just a combination of cash and equity. Currently, valuations are still very strong for Class A assets, but they have cooled off to some degree comparative to the marketplace in 21 and 22. And we are seeing that deal structures are evolving to preserve cash. So we're seeing a little bit lighter cash at closing. We're seeing joint venture equity becoming more and more common. And we're seeing earnouts and holdbacks and pref A equity start to creep back into deal structures, which were very common pre-COVID, but disappeared when there was so much competition among DSOs and private equity to buy practices in 21 and 22. So valuations and deal structures are constantly evolving, but I will say that there's a lot of optimism in the space comparative to the back half of 23 and throughout 2024. So I think we're going to see that consolidation is going to continue. You're going to see that a lot of the market conditions we're talking about right now are going to continue into the foreseeable future. But we're going to see recaps at favorable multiples. We're going to see renewed PE interest in our space and a lot of optimism on a go-forward basis. I'll comment that 2024 was actually a high watermark for our company from a perspective of number of transactions closed and total enterprise value closed. I don't think that's necessarily reflective of the market as a whole, but it is reflective of the fact that deals are still happening, valuations are still good, and there's still plenty of sell side and buy side activity. I think one of the reasons we were so busy in 2024, we've obviously been growing the brand, but also I think large practice owners have come to the conclusion that they need proper representation if they're going to take their practice to market. There's been some blood in the water. There's been some DSOs that have failed. So choosing the right partner, negotiating the right deal structure is critical to having a good long-term economic outcome from pursuing a sale. And we expect activity to remain very high on the sell side and buy side moving into 2025 and beyond. So let's talk about how those institutional investors are scrutinizing and evaluating DSOs when they go to recap. The financial engineering that was occurring, leading up to 2022, whereas DSOs were really focused on acquiring as much EBITDA as possible and cost averaging that EBITDA at acquisition cost of 7 to 8x, and then flipping the investment to the next investor for 12 to 15x. That is no longer enough to generate the types of return and the type of marketability and demand from institutional investors when you get to the point that you want to recap. So investors now are looking at, what is the backstory? What was the investment thesis of that DSO at its inception? And have they stayed true to that investment thesis throughout the evolution and growth of the company? How compelling is that backstory? Do these practices have commonality? Do they have geographic density? Or are there like darts on a map all over the country? Has the DSO grown really without any intention? And if that's the case, if you have grown without intention, if your practices don't have commonality, if you don't have geographic density, if you haven't developed real infrastructure and actually integrated and operated the assets that you've acquired, there's not going to be a buyer for that DSO when they look to eventually go to market and monetize the business. So investors have gotten wise to the fact that they want to acquire DSOs that are real companies, that have real infrastructure. They've been thoughtful about the practices that they are acquiring. They've integrated those practices and built the infrastructure they need to operate those practices and do it effectively. So that's when the conversation about same-store sales growth comes up. It's great that you've went out and bought 200 offices, but how have those businesses performed from a revenue and EBITDA perspective post-acquisition? Have they actually grown or have they moved backwards? So paying attention to the quality of the assets in the portfolio and the performance of the assets in the portfolio post-acquisition has become paramount for institutional investors that are evaluating DSOs at recap. They're also looking at deal structures and how thoughtful those deal structures are in the sense of aligning incentives with their doctor partners and primary producers. Because DSOs have come to understand that doctor turnover, in particular founder turnover, is their Achilles heel. Dentistry is a provider-centric business. And if the doctors are not happy, if the DSOs don't create meaningful culture and drive efficiencies from an operating perspective to their doctor partners and allow for clinical autonomy and clinicians and practices to thrive under their leadership, they know long term that that business is not sustainable. So looking at the deal structure, how are financial incentives aligned? Do the doctors own parent company equity? Do they own practice level equity? Do they own a combination of both? And how is that going to dictate how the doctors behave post recap? Because once there's been a big liquidation event and doctors have gotten to that second bite of the apple and taken more chips off the table, in addition to the chips they took off the table at the initial sale, are they going to stick around? And if not, is there a succession plan in place for those doctors that are eventually going to retire, relocate, or leave the business for some reason or another? So looking at alignment with doctor partners and primary producers, in other words, how are you incentivizing associates as well? Is there an on-ramp for equity for associates? Are they vested in the continued success of the business? Because the associates that are the primary producers in these practices are the successors for the founders that will eventually exit. So long-term sustainability is a big deal. Do you actually have a professionalized, integrated, real business with infrastructure and long-term sustainability? So there's a lot that goes into reaching a lucrative outcome at recap comparative to what was going on in 2021 and 22 when private equity was investing really without doing their homework and being thoughtful and pragmatic about the assets they were acquiring. So along those lines, the next 3 slides are really focused on how to scale and position your business to get a good outcome when you go to monetize it. And a lot of what we've talked about so far as how institutional investors are scrutinizing DSOs when they go to recap, there's kind of trickle down effect, if you will. The institutional investor's behavior is now influencing how the DSOs and private equity firms behave when they go to acquire assets like yours. So first, let's talk about scaling your practice with intention. You saw the same bullet point on the previous slide, making sure that your practices have commonality and geographic density. You don't want dots on the map across 5, 10 different states. You want to build geographic density. That's how you really create efficiency and economies of scale for an emerging DSO. And then commonality. You don't want to go out and buy a fee-for-service practice, buy a PPO practice, and go buy a Medicaid practice. You need commonality from a payer mix. You need commonality from a procedure mix. You need commonality in regards to the systems that you're using in your practice, both practically and from a tech and operational perspective. So commonality is key. And that's where you often hear me talk about the fact that I'm not a big fan of the roll-up concept, in the sense that you can wrap your arms around 25 to 50 unaffiliated practices that don't have a lot of commonality, maybe not even geographic density, pretend that they're a DSO and sell them to private equity for an increased multiple comparative to what the individual parts of that roll up are worth. The reality is that most of those roll up concepts have failed remarkably to come to fruition. And it's because of this reason, because DSOs, private equity, they want the practices to be fully integrated, to have commonality and geographic density. You need to determine who you are from a growth perspective. Do you want to scale via acquisition? Do you want to scale via de novo? Those are 2 completely different animals, or do you want to do both? I would argue that you will fetch likely the highest level of demand and valuation if you have proven that you can do both. But you need to be careful, because your approach to acquisitions versus your approach to de novos should be remarkably different, because they are 2 different animals in order to be successful in scaling in those 2 models. And then if you're going to scale via acquisition, develop an avatar as to what does a prime acquisition target based on your investment thesis look like. Don't go acquire practices just because they're there. You need to determine, am I focused on buying PPO and fee-for-service practices with 6+ operatories, revenue of $1 million to $2 million in 3, urban geographies that are all in the same state? You need to be as specific as you can be, and then only look to acquire practices that match that avatar. Do not stray outside the box, or it's going to cost you from an operational perspective and from a financial perspective when you go to monetize the business. If you're going to move towards a de novo model, you need to make sure that you've got great staff, you've got great systems, and you can replicate those systems. You need to think hard about geography, you need to think about retail visibility, and you need to think about demographics. All of those things are going to determine whether you're going to be successful scaling your business from a de novo perspective. And realizing that if you've scaled up to that point doing acquisitions, de novo is a different animal. Or if you've scaled up to that point doing de novos, acquisition is a completely different animal. And you need to evolve your systems and your processes to assimilate to whatever growth model you're going to pursue from that point forward. In my opinion, each office needs a roadmap to generate 2 million in revenue or more. You typically have to generate 2 million plus in revenue to get to an EBITDA margin of 20% plus. And we're going to talk in a minute about what it means to be a Class A asset when you take your business to market. And you're going to want to have a EBITDA margin of 20% or higher. So I would like to see each practice generate over 2 million in revenue and a minimum of $500,000 in EBITDA. And if you currently own offices that don't have a roadmap to get there, I would consider divesting yourself of those assets. And then on a go forward basis, if you're going to acquire practices or pursue de novos, ensure that you only pursue practices where you believe that you've got a high probability of reaching 2 million plus in revenue, 500,000 plus in EBITDA before you go to monetize the business as a whole. Here's a big one. Focus on revenue and EBITDA growth and efficiency. Focus on same-store sales growth, focus on profitability versus adding additional storefronts. I feel like a lot of dentists think that more locations means more EBITDA, means a higher valuation. And the reality is that more locations comes with more overhead, both from a staffing perspective and from an occupancy cost perspective. I would much rather represent a business with 2 locations, $5 million in top line revenue, and $1.5 million in EBITDA, compared to a business with 5 locations and $5 million in top line revenue and only $1 million in EBITDA. The 2 location business with $1.5 million in EBITDA might trade for a slightly lower EBITDA multiple because it has less storefronts, but it's going to trade for a much higher valuation because the EBITDA is 50% higher. So don't focus on number of storefronts, focus on EBITDA, focus on efficiency, focus on profitability. And if you're in the position where you currently own 5, 7, 10 practices, but really 3 or 4 of those are weak assets that don't have a roadmap to generate 2 million in revenue, that don't have a roadmap to get to 500,000 plus in EBITDA, divest yourself of those assets and focus on making the assets that you own grow and become more profitable. And then again, develop that avatar for the type of practices you want to acquire on a go forward basis and stick to that plan. You need to be thinking about leadership, infrastructure, integration, and operations, especially if you want to be considered a platform for a private equity firm to establish a new DSO. So making sure that you are investing in leadership, both at the DSO level and the practice level, making sure that you're building the appropriate level of infrastructure to operate and scale your practice on a go-forward basis, and making sure that you're integrating and operating the practices that you're acquiring or opening. That's key to having a good outcome when you go to monetize the business. And also, not putting the cart before the horse, not building infrastructure, making a massive investment in talent and in the growth of your business, only to not see that growth occur or decide to pivot to selling the business before it's matured to a point where you've offset that investment in the infrastructure and leadership of your business. So that's where I think it's important to think about your different inflection points and thinking about when you're going to look to monetize the equity in your business in part or in full, when you're going to take on a partner. Because once you get to, 3 to 5 locations, at some point, you're going to have to start building out some centralized infrastructure and building out some leadership, middle level management, maybe even a C-suite. And that comes at a huge cost and a time commitment. And it erodes EBITDA, at least temporarily. The business is going to have to grow significantly to offset that cost. And it may make more sense to monetize a piece of the business and take on a partner that's already made those investments that already has that infrastructure rather than doing it yourself. One of the big things I would encourage you to do is to evaluate your legal structure, evaluate your entity structure, and make it as simplistic as possible. I cannot tell you how many practices we've seen, whether it's multi-site practices or single-site practices, that have an overly complicated legal structure where it makes it extremely difficult to follow the financials. So maintaining clean and updated financials is also critical. Know your EBITDA, make sure you've got a good CPA, make sure your books are updated and clean. Because if they're not, it's going to make it far more challenging when you go to exit your business. All right, so how to position your practice to be considered a Class A asset. So geography. Most DSOs and private equity firms are looking to acquire practices within 60 miles of a major metro area. So let's say one of the top 50 MSAs in the country. Ideally, you would be located within 60 miles of those. That doesn't mean that if you're in a tertiary market, in a rural market, you have no options and you can't monetize your business. It just means all things equal, you're not going to see as much demand, meaning that you're likely going to have a lower valuation compared to a peer that's in an urban or suburban market. So being in a geography where DSOs and private equity wants to play, I think is critical. The consolidation of the dental industry is occurring across the entire country now. I would argue that there are states where the activity level is crazy high, like Texas and Arizona, Florida, the Southeast. But we are starting to see New England consolidate. We are starting to see more and more DSO activity on the West Coast. So it's happening across the country now. But if you want to maximize demand and valuation, you want to be in a top 50 MSA, urban or suburban geography. Multiple doctors, this has become a huge talking point in the DSO and private equity world. They want to mitigate key man risk. And the way to mitigate key man risk is to bifurcate the production among multiple providers. So typically, the more doctors you have, the less reliant the business is on a single producer, the higher the demand, the higher the valuation. EBITDA of $750,000 plus. DSOs used to start to get excited around EBITDA of $300,000 plus, but we've seen less and less demand and lower valuations for practices with EBITDA under 500,000 more recently. Most DSOs get really excited, demand really ramps up, valuations really ramp up once you cross about $1 million in EBITDA. And they're paying very close attention to EBITDA margins. They want to buy healthy businesses that are operating at an EBITDA margin of 20% or higher. Same-store sales growth, as I've mentioned several times, is a massive consideration for DSOs, both when they're looking at acquiring businesses as well as they know they're going to get scrutinized from a same-store sales growth perspective when they go to recap their own business. So an increasing revenue and EBITDA trend is going to elicit higher demand than flat revenue and EBITDA or declining revenue and EBITDA. You're going to want to go to market always with a growth narrative. What is the post-closing growth potential of your practice? Can you layer on specialty? Can you add another location? Can you expand the facility? Can you add another doctor? You're going to want to highlight ways that you can grow your practice post-closing. That's going to be critical to increasing demand and valuation. And then thinking about doctor alignment and retention, buyers are going to want to make sure that the founder is willing to have a vested interest in the business long term, and that the primary producers are going to be retained and are excited about doing a deal and staying on post sale. So moving into that, let's talk about aligning incentives with doctor partners and associates. I bring this up because we are seeing a growing trend of large practice owners selling minority equity interests to their associate doctors, which I think is great so long as everybody's swimming the same page and is on board regarding the eventual plan to monetize the business. And what I've seen recently is that the founder has brought on several minority partners And then when the founder's ready to monetize a majority of the business in a private equity sale or a DSO affiliation, the minority equity partners who are major producers try to block the transaction or not in favor of monetizing the business in that way. And irregardless, if you have a tag along, drag along right, irregardless if you have a unilateral right to sell the business without the blessing of your minority partners or associates, if they are not on board, they could block the sale or significantly adversely impact the value of your business. So ensure that you make promises thoughtfully with your associates and your partners. Ensure that if your goal is eventually to monetize the business in a private equity sale or DSO affiliation, everybody's swimming the same direction from day one. They know what your goal is, and they are willing and able to participate when it's time for that liquidation event to occur. You're going to want to make sure that you have a tag along, drag along rights. That you have a unilateral legal right to sell the business without their permission. Again, they're going to have to play ball. They're going to have to be on board, but you do want to make sure that in your operating agreement, you have that tag along, drag along right. I'll tell you that the more partners you have, the more challenging it is to sell because you have to get everybody on the same page and they all have to agree to sell at the same time to the same buyer with the same deal structure. And that can be difficult. We've navigated quite a few sales where there were 4, 5, 6, 7 partners, and it can always be a bit of a challenge getting everybody on the same page before we go to market, and then keeping everybody on the same page as we navigate the sales process. I'm a big fan of offering a profits interest to associates rather than actually selling them equity. Gifting them a small profits interest rather than selling them equity is far simpler and gives you far more control over what happens when you go to monetize the lion's share of the business. And I say that because it can essentially function the same economically for the associate doc. A small profits interest that's given can throw off the same level of cash flow as an equity stake that is purchased. And at a liquidity event, you can design that profits interest in a way that essentially functions as equity, converts to equity at a liquidity event, and your profits interest partner can participate alongside you in the sale of the business, pari passu, so long as they're willing to agree to the same terms and be on board with that transaction. If they're not, then I would design the profits interest in a way that it's forfeited if they stand in the way of the sale and are not on board with how you ultimately decide to monetize the lion's share of the business. If you're not going to do some type of profits interest, if they're not going to be equity partners, if they're purely associates, you need to be prepared for the fact that if they are major producers, you may have to offer them some type of retention bonus to sign on with the DSO or private equity firm at the time of sale. Or you might have to give them some form or level of equity at the point of the transaction. The good news is most DSOs have an on-ramp for equity for associates these days. They want the associates to be incentivized to stay with the practice and continue to help grow the business and be a good shepherd of the business on a go-forward basis. But I think you as the owner need to be prepared for the fact that you're going to have to incentivize your primary producers to hop on board with whatever transaction you decide to pursue. So, talking about keys to maximizing your outcome at a sale. Obviously, you want to position your practice to be considered a Class A asset, to check all those boxes we talked about previously in the presentation. You need to choose the right time to go to market. Now, I'm not talking about timing the market from an macroeconomic environment perspective. Look, the reality is that valuations have cooled off slightly since their peak in 21 and 22. The reality is that interest rates are not going back to zero, and the capital markets are likely never going to look like they did at that point in time. So if you think waiting a year or 2 years or 3 years that the macroeconomic environment is going to improve and valuations are going to get more robust, I think that's a fallacy. I don't think that's going to happen. Valuations are still very strong, very attractive, but I don't think they're ever going back to the high water mark they were at in 21 and 22. So trying to time the market from a macroeconomic perspective is not what I'm talking about. What I'm talking about is choosing the right time to take your particular business to market, predicated upon its revenue, its EBITDA, the backstory, the revenue and EBITDA trends, and the growth potential on a go forward basis. Talking about the investments that you need to make to continue to grow and scale your business. Are you going to make those investments in that centralized infrastructure? Are you going to build out that leadership team and therefore have to grow and wait 2 or 3 years before you go to market? Or does it make sense to monetize the business today and leverage someone else's capital and infrastructure to continue to scale the business? Those are the things that you need to be thinking about. If you're a de novo model, right, and you're thinking about adding additional de novo offices, it takes time for those practices to mature and generate a meaningful amount of revenue and EBITDA. So you probably don't want to open 2 or 3 offices right before you look to monetize the business. You can account for that when you go to market, but you're not going to get near the valuation for those immature practices as you will for the seasoned portfolio of practices that you owned. And if you got to get real creative regarding how you're going to be compensated for those practices that have not yet matured in the transaction. So choosing when the right time to take your particular business to market, I think, is key. And also just looking at, what is your exit plan? When are you planning to remove yourself from the business, and how does that interact with your decision to take the business to market? You've got to have proper representation. You need a strong sales side advisor. You need to use somebody like us to represent you if and when you take your business to market. You need to have an experienced dental attorney on your team. You need to have a great tax advisor on your team. You need to consult with your financial advisor. Can you afford to sell? And then what are you going to do with the windfall of capital that you receive in cash at closing at the time the transaction closes? And you need to involve, obviously, the key people in your life, your spouse, and your key doctor partners, your key producers in this decision. Don't respond to an unsolicited offer. Private equity firms and DSOs are designed to contact you directly without somebody like us at the table, and with the goal of essentially taking advantage of you, buying the asset for as little as possible and then selling it at recap for as much as possible. And the number one way that they manipulate valuation is to control the narrative regarding EBITDA. So you've got to make sure that you've got a strong sell-side advisor that's got the back office that's capable of controlling that narrative regarding EBITDA, both pre-LOI and during the quality of earnings process. I mean, I feel like 80% of my team's job on a daily basis is arguing with DSOs and private equity firm about the EBITDA of our client's practice. So controlling that narrative and being prepared to defend EBITDA is critical to maximizing valuation. Every dollar of EBITDA is worth $7 to $10 in value. So the EBITDA matters way more than the multiple. Now, obviously, our goal is to move the needle on both the EBITDA multiple and the EBITDA itself, but EBITDA moves the valuation far more than the multiple. You've got to create a competitive environment for your practice. You need perspective as to what your options are. And the only way to create perspective is to be in a multiple offer situation. So that's really where we come in to make sure that, one, your practice is ready to go to market. You present the practice to buyers in the most favorable light. You create a highly competitive environment among multiple buyers simultaneously, control that narrative regarding EBITDA, and then bring you as many options as possible and leverage that competition to maximize the valuation. I would also tell you, don't focus solely on valuation. You're not going anywhere typically after you monetize your business. And there's going to be an equity component involved, whether that's practice level equity or parent company equity or both. So you need to pay very close attention to fit. Are they the right partner for your practice? And deal structure, and vetting how healthy that DSO is, and the probability of them reaching a recap at a favorable outcome on the equity component. Because if done well, if you pick the right partner with the right deal structure, the second bite of the apple, the secondary sale of that equity could be as lucrative as the initial cash at closing. To walk you through our process, we always start with a casual confidential discovery call. Typically, you spend 30 minutes with me just to get to know each other, learn a little bit about your business, and see if it makes sense to do a detailed EBIT analysis and valuation. So, following that discovery call, next step is to do the EBIT analysis, do the valuation, quantify what is your EBIT today, what is your business worth, what are the strengths and weaknesses of your business, and if you're not ready to take it to market today, what changes should you make to your business to reverse engineer the financial outcome that you ultimately want to achieve when you monetize the practice? Assuming that, and then once we get through the valuation, we go over it together, talk about strengths and weaknesses, and we discuss options. We can do some financial modeling to show you if you sold the business today under several different deal structures, what does the global economic outcome of pursuing a sale look like? Cash at closing, annually, post close, as well as cumulatively, and factoring in one recap into that equation. So let's say we have the discovery call. We do the valuation, we go over the options, and it makes sense for you to go to market. At the time you're ready for us to take the practice to market, we sign a listing agreement and we take the practice to market utilizing what we call a blind bid process. Valuation conversation is a private conversation between you and me. I represent you. I don't represent DSOs. But when we take that conversation is designed to align expectations, right? If I tell you your business is worth 10 million, but you think it's worth 20 million, well, I'm in the business of selling large practices on a daily basis. I know what it's ultimately going to trade for. And if you think it's worth 10 million more than what I believe the market's going to bear, then let's press time out. Let's make some changes to the business to reverse engineer that outcome you ultimately want to achieve. But the reality is now's not the right time to go to market. But let's say I say, hey, we think we can fetch a valuation of 10 million if we take the business to market. When I take the business to market, I'm going to utilize a bid process. The DSOs are never going to know the conversation we had about that baseline expectation of value. If I can get 12 million, 13 million for the business, I'm going to ensure that we don't leave a dollar of value on the table. That's why we use that blind bid process when we take the practice to market. We're going to create a highly competitive environment among multiple buyers. On average, our deals are going to see somewhere in the range of 5 to 10 offers. We're going to help you interview and vet the potential buyers to evaluate fit, evaluate deal structures. Once we have the letters of intent come in, we're going to plug those LOIs into that cash flow illustration I mentioned earlier so that you can compare apples to apples and understand the global economic implications of each offer long term. We're also going to determine which buyers are buyers you feel are the best fit for your practice and negotiate the offer with those buyers. There might be a clear front runner that we choose to negotiate. There might be several front runners where we ask for best and final. Once we sign an LOI, we quarterback the closing process from start to finish. Any advisors that you need on your team, whether it be an attorney, accountant, financial advisor, whoever it might be, we can absolutely bring those to the table. And we're going to be there to help navigate and negotiate the legal agreements, as well as, this is very important, defend your EBITDA throughout the closing process. As it comes to the quality of earnings process, there's a lot of back and forth when it comes to EBITDA defense. That's why we have financial analysts on our team. That's why we have a CPA on our team. A big part of where we earn our fee is ensuring that the deal terms we agree to in LOI survive the closing and there's no retrade. I really appreciate you spending the last hour or so with me. I would encourage everybody that watches this webinar to click on this QR code or text me to schedule a confidential, casual discovery call just to get to know each other and talk about how we might be able to help you build and scale a valuable business and eventually plan to monetize it at the top of the market. Hilda, thank you so much for having me, and have a great day, everybody.
Yes, thank you, Brandon, for sharing your expertise and your valuable insights. And thank you, everyone, for joining us. We hope this helped you better understand the current market and whether it's the right time to sell. If you have any questions or just want to talk through your options, don't hesitate to reach out to Brandon. He has these conversations on a daily basis and enjoys helping practice owners figure out the best path forward. So give him a ring or scan the QR code to schedule a discovery call. Thank you all again, and we'll see you next time.